Hello, and welcome to today's webinar panel discussion on how to achieve effective collateral management, hosted by Risk.net in association with SmartStream. My name is Blake Evans-Pritchard, and I'm the Asian Bureau Chief for Risk.net. With me, I have a group of industry experts that are able to provide informed insight into the challenges associated with collateral management. Trevor Negus is Product Manager, TLM Collateral for SmartStream Technologies. Karim Chabain is Regional Head of Collateral in APAC for Citi. Michael Cyrus is Head of Collateral Trading for DekaBank. Teruhiko Kuniyasu is Head of Collateral Management Unit at Mizuho Bank Credit Management Department. It falls to me to point out that all views expressed by the panelists are their personal views only and not representative of their respective organizations. Today's broadcast is intended to be as interactive as possible, so if you have any questions, please send them in and I will endeavor to put your points to the panelists. We will also have a series of polling questions. The COVID-19 pandemic has thrown a spotlight on sound collateral management practices as markets have become stressed and margin calls have nudged upwards. What had previously been seen as by many as a painful regulatory exercise has now reinforced its value as a risk mitigation tool. At the same time, spikes in margining have put pressure on collateral availability and focused everyone's attention on being able to get hold of the right collateral when it is needed. Whilst attitudes towards collateral management have been shifting, the delay of Phase 5 and 6 initial margin reform has provided some breathing space for reflection. So with that, let's turn to our first polling question, which is for the audience. What has been the largest impact on your team over the last 2 months? Working from home, volume of calls and disputes, shortage of collateral, reporting demands, information dissemination, system outages, or cyber security. So I'll give that 30 seconds or so for the results to come in. Okay, maybe we can take a look at the polling results. Okay, so working from home has had the biggest impact, possibly not a surprise there. So let's turn to our panelists to get a quick overview of the current sort of global collateral management landscape and how COVID-19 has affected this at all, or if it has. So I'll turn to Teruhiko first on this. From your perspective, sitting in Japan, how have you seen global collateral management landscape developing this year?
Okay, thank you, Blake. My name is, by introduction, Teruhiko Kuniyasu. I'm with Mizuho Bank. I'm based in Japan. Let me give you a brief comments on what I have seen during these few months. Well, first, on February, the coronavirus was designated as a designated infectious disease, and we had like compulsory hospitalizations of the infected persons, and that was approved by the government. So that was like, wow. We also had like a temporary closure of all schools from March until like spring breaks to prevent the spread of the virus. And as you may be aware, the Tokyo Olympics, the games was like postponed by a year. Actually, the market kind of like rattled negatively, which led to the dollar-yen rates to move between like 102 to 110. Now, we had a very high volatility in the market. As a result of this very high volatility in the FX markets, the margin calls numbers like hiked from 1.5 to like 2.0 folds as compared to the normal BAU, which is business as usual. Now, due to this, we had a very high burden on our daily operations because we had split operations, which we usually do not operate. And we were not used to operating under these very critical environments. So that was very tough items which we had to tackle in order to get all of the margin calls done, the settlements to be placed, and of course, we have to be in line with the regulations of the margin regulations. So that was a very big challenge to our banks and our team. Okay, so that was kind of like items which I noticed during these few months.
Okay. Thanks for those thoughts. We'll sort of come on to some of the sort of challenges and explore further how things are developing in a moment. But Kareem, how have you seen things from your side play out when it comes to collateral management?
Yeah, thank you, Blake. So maybe just first, I just would like to clarify or mention that from a city perspective, I'm running the collateral product where we act as a collateral agent to our clients, as opposed to running the collateral management for Citi as a bank or a trading entity. So I think in line with what Kuni-san was describing, we have also seen the same kind of order of magnitude in terms of the volume of margin calls, especially during the month of March, driven by the volatility. The working from home arrangement on our side has been, reasonably smooth and probably even, I talk personally, smoother than expected. I think it was quite impressive to see how the teams have been able to adapt. Now, obviously, from a technology perspective, we had the luxury of effectively operating from a platform which is accessed from different locations. So we had these capabilities for effectively backing up the different operation team and the different sites. The reason I mention that is that, in certain countries, because we have operation teams based in India, in certain countries, then I think the complete lockdown was a little bit unexpected. So there was some nervousness about, how it's going to pan out. But I think the resilience has been quite impressive in terms of how operation were allowed to continue almost seamlessly, almost independent on where the teams were effectively located. I think then probably from a client perspective, definitely the increase of margin activity, the increase of volatility was effectively, attracting the focus on the increase on counterparty risk. So there was quite a lot of focus from the clients about following up during the day on how things were unfolding. So there was much more scrutiny about margin collateral being in transit, being sure about when it's being received to make sure that you can close out your open risk on your counterparts, and eventually that I would assume that within those firms there would be like internal dialogue between their risk management unit and the operation about the fact that some lines, trading lines or credit lines would eventually be released to make sure that the trading activity would effectively continue. And finally, and I'm sure we're also going to probably talk a little bit more about that later during the panel, is I think for the clients who were using external agents, they could effectively test how much those agents were able to absorb the volume, because that's one of the key risks that you take when you decide to go into that kind of appointment of an agent or outsourcing decision. So you don't put yourself the resources in order to run the product with the view that the scalability should come from the agent, and I think that's quite important, and it's also focus the I would say the lens back on collateral management as a risk mitigation activity, as opposed to just simply regulatory or a regulatory tick-the-box exercise.
Okay. Okay. Thanks, Karim. A very interesting point about the focus on it as a risk mitigation. More of a focus on it as a risk mitigation technique, and I'm sure we'll sort of explore that a bit further in a minute. So maybe we can sort of bring in a European perspective here. Michael, what you've been seeing in Europe, similar in terms of increased volatility leading to more scrutiny on the margining collateral function?
Yeah, definitely. I mean, we had huge reallocations of collateral pools. I think most people were caught on the wrong foot, and consequently, we had seen maximum replacements and reallocations of all different sorts of collaterals vis-a-vis the exchanges, but also vis-a-vis all the bilateral clients. And at the same time, we also had a huge increase in margin requirements as interest rates were going down. In many cases, in particular, banks had to post more collaterals to the exchanges. So margin requirements were up at a time when the unsecured markets were broken. So it was very difficult for many banks to replenish their collateral pools because they had a situation that left, right, and center the unsecured markets were going into a freeze situation. So it was difficult to source additional collaterals that you would then need to cover your positions at the exchanges. In Europe also, the situation is always a little bit probably more complicated because of the fragmentation and the hierarchical structure of our European monetary system. So we, for instance, had a situation when we were trying to post collateral, ECB eligible collateral, to the Bundesbank or via our Bundesbank account, and then we found out that the Bundesbank systems would not be able to process this type of collateral. And then they said, okay, sorry, you have to do this via Belgium. So we don't have any kind of setup with the Belgian central bank. So in the end, we could not deliver or could not tender our collateral. And all this obviously happening against the background of in our bank where we had 100% of our employees just moved over the course of 4 weeks into the back offices. Also to bring this in perspective, I think in Germany, most banks have been operating or are operating with something like 30 to 50% people in the home office. So we have been a little bit an outlier here for a couple of reasons. But we said, okay, we move 100% of our people back.
Okay, thanks. And Trevor, what have you seen as being speaking to your clients, across the sort of collateral management space? I mean, do your views accord with the other panelists?
Yeah, I mean, they're pretty much in line with what's been said around the issues of obviously volumes increasing massively because of the volatility, so margin calls up, and with that potentially comes disputes up and potentially also fails up. And unlike other crises, like after Lehman Brothers, people weren't in the office, so it made it doubly difficult. So most of all of our clients sort of switched more to a run the bank, run the firm sort of processing rather than looking at strategic issues. And obviously that's sort of changed now as things have evolved. But certainly in the early days, it was battening down the hatches, as it were. In terms of the points raised by the other panelists, yes, I mean, I suppose the big issues was collateral squeeze. The collateral requirements were up, as Michael said. So it wasn't business as usual in terms of are receiving collateral and they can rehypothecate it out, and people were having to look at other places for their collateral, other inventory pools that they have, and potentially even for some funds, unwinding positions and trading out positions. And with that shortage of collateral, people were, as Michael said, having to look at different types of collateral. So where in the past perhaps they were posting, government securities, they may have had to post corporate. And with that, different eligibility and concentration rules, but concentration rules specifically kicked into place. So clients may not have had those set up in their collateral system because they've historically just been posting government bonds, but once they start posting corporate bonds, then the concentration rules apply, and so people were sort of frantically loading those into the application. They were in the documentation, and as well as that, I think there were people who genuinely had to amend their eligibility schedules, so they needed to update those schedules, renegotiate, and that obviously called into the whole issue around negotiation when you're not in the office, so the digitization of agreement negotiation. So there was a whole lot of things that came together at the same time, the volumes, people not being at home, and then the adjustments to the eligibility schedules and the kicking in of concentration rules. So, all of those things really.
Okay. Thanks for that. So I wanted to take a bit of a sort of deeper look at some of these sort of challenges and issues that have surfaced around collateral management, and particularly look at maybe touch on what the future of collateral management might bring now that this is we've been through, or we're in the middle of going through this sort of COVID-19 pandemic that has uncovered some sort of issues with collateral management, or perhaps refocused people's attention on that. And Karim, I thought it was quite interesting the point you were making about sort of perhaps shifting focus slightly, or sort of emphasizing collateral management as a risk mitigation tool, more than just a kind of like sort of regulatory exercise, and the fact that there's going to be potentially more focus on that. Karim, maybe I can go to you first here in terms of taking a stab at what the future might look like. Is this going to be a significant shift, do you think, at about how people perceive collateral management?
Yeah, absolutely. I think there are a couple of maybe examples or events that we can take from the last few weeks or months in relation to the exceptional situation we've been going through. It's also interesting to see that in the background, regulators came up with the decision of postponing regulatory initial margin postings by another year. I think what's interesting is because you are much more concentrated about mitigating the counterparty risk in case your counterparty goes into default. So basically, you're really now looking at establishing your collateral management procedures to protect you, as opposed to just to comply with the regulation. I heard about, or I've seen certain discussions where clients or counterparts were also thinking about whether they should put or add any kind of independent amount, or making sure that additional collateral or taking bigger haircuts, as Trevor mentioned, was probably appropriate to implement right in the middle of the crisis. And I think in the meantime, you've seen regulators deciding to push by a year phase 5 and phase 6 of initial margin, and while they were doing that, you realize that although it's absolutely true that it brings a certain amount of relief in terms of the preparation, given the fact the focus is now on what's happening as we speak. and the complete unfolding of this COVID-19 situation. You don't want to divert your resources into implementing the project. But I think at the same time, especially in the discussions that we had with our clients who are effectively implementing the unclear margin rules for initial margin, you realize that they haven't really decided to move their implementation plans by a full year because they realize, that maybe it's not that prudent from a risk management perspective just to postpone everything. They probably are considering whether they should take a kind of early adoption, even if they're not pushed by the regulation, by the regulatory deadline, for making sure that they properly mitigate counterparty risk exposure. So I think that has been quite, interesting to see how the mindset has changed. Other things that you've seen eventually has been about thinking how you can reduce your margin requirement, eventually shift your business between different, poles of activity, including central counterparty clearing. But I would say that was already there before the crisis. Maybe that the situation has precipitated a little bit the thinking, but surely. You really identified that new trend about collateral is there to mitigate risk more than just being a regulatory obligation.
Okay, thanks for that, Karim. And you actually answered one of the questions that are coming from the audience there on initial margin and kind of readiness for that, and whether people are still sort of strategically focused on this. So a sort of interesting thoughts there. And I want to sort of maybe turn to Hiko on that. Maybe from a Japanese perspective, you can give some thoughts of how this whole COVID-19 situation is likely to affect sort of collateral management preparation in Japan. And also maybe you could address this question we have from the audience, which is talking about readiness of initial margin and the extent to which people have stepped back from preparation from initial margin since the deadline has been postponed, or are they still very much sort of continuing on with that? So Teruhiko, what are your thoughts?
Okay, first, I'd like to talk about the changes in the mindset of people, especially in Japan. As Karim mentioned earlier, the city banks and I should say many large European American banks, they already have been investing in their internal systems for over a very long period, even like more than a decade. And the system is in place. So compared to those like very large banks, many banks actually in Japan, the COVID was a wake-up call for everybody here. And what I'm trying to say is that we were not ready, we were not really ready for the remote work, or what we could say is like work from home. Now the government said, yeah, please work at home. So we just did. But the fact is that we had not much of a tool to work at home. So actually what we did was like COVID is like a test of an BCP, which is like a business contingency plan. And we had to do this in real life. Usually maybe this will, prolong for just a couple of days. As in like, let's say a hurricane could last like 1 day, 2 days, 3 days. But actually this BCP, which we were put to use, this was actually had been going on for a few weeks and even like extending to few months. Now, this is not a BCP anymore. This is what we call a BCM, Business Continuity Management. And this is what we have been, practicing. And it was put to real use. In action. And now this BCM has been going on for a long time. And now we have been calling this like a new normal, which is the BAU. This is the business as usual, as many people are aware of. So actually in Japan, this was a very good wake-up call to promote the work from home. And to do that, actually, we have to invest in systems and we have to go to a cloud environment. where we can like work from home. So people are actually talking about a more aggressive way to address this, such as like solution to all of this COVID. It could be through like a real-time inventory management. But for me, actually, I thought that this was an acceleration, the need for a more cloud environment. For example, like the mainframe systems, such as the general ledger systems, the settlement systems, the SWIFT systems, can you operate this from your house? And many of the banks here in Japan is like, no, we cannot. So now banks in Japan are now trying to restructure their internal systems so as to be more cloud compliant is what I call it. Also, what I would like to address is that we did have some kind of difficulties in like communications from home, such as like a chat application. We have this in Mizuho, and also like the regular emails. So the communication actually is that was very important for us to communicate from the staff members to the managers. And I call this like a vertical communications from the bottom to up. But also is very important, and which I have seen in the market, is the lack of horizontal communications. And that horizontal is meaning that the staff members is talking to the other staff members at home. Now this is, if you're in the office, this is very easy. Your boss is just there, your colleagues are just next to you, and then you can just talk. But to do this at home, we need communication systems, not just emails, not like telephones. We need like, FaceTime, Zoom, WhatsApp, whatever is needed for the chat applications. So proper communication is also very important. And if you want to run your operations smoothly under these very, critical moments, you need to, get it right smack to get your operations running. So it means that you need to, precisely instruct, and your staff members also will need to know, what's going on between the other members also. So if you push this limit a little bit more, your members will be talking to each members. And if you want to like decrease this burden, now you have to go on to more cloud, STP, robotics, and like system interfaces. This is actually what we have seen, and it is a good thing that our banks is like trying to invest, and we are getting there slowly but surely. So the actual, impact of the COVID-19, for me, we had a very bad part of it, but, it's not just a bad part. I'm trying to look at it as a good part, and it did kind of like, woke up everybody. So we are trying to work from home and really work from home, not just stay at home and do nothing. So that was like my observations for this few months. And the second thing is regarding the extension of the regulations to 1 year. There's a good part and there's another bad part. Is what everybody's mentioning is we have another additional 1 year. People who have not been very well prepared they were saved. But many of the banks here in Japan actually have been, progressing well, and most of the items have been achieved. So what many of the customers actually are saying is that they're not going to sit back and relax. They're just going to finish off by September or even like October. And they have trying to, adopt early, and that was good. But for people who have, extended their project for another 6 months or a year, now I think, they're going to have another difficult situation, because now it's not just like managing your projects. You have to manage your projects at home with this COVID-19, because it's not going to disappear. The COVID is going to be with us all year round. So I think, things have, increased difficulties because of this COVID. It's not going to go away. So that is my view.
Oh, okay, thanks. And it's probably a good moment to bring in our second polling question here before I get the other panelists to also talk about the challenges. So we'll bring in the second polling question, and also remind the audience that if you have any more questions on any of this, do send them in, and I'll put them to the panelists as they fit. So this polling question is, what do you see as your collateral team's focus over the coming 12 months? Technology enrichment, accommodating increased volumes, attracting talented staff, regulatory compliance, cost reduction, managing collateral inventory. I'll just wait for 15 seconds or so for that to come in. Okay, and taking a look at the result. Okay, so split between technology enrichment and regulatory compliance. And we're going to talk a little bit in a minute about the ways in which technology could potentially help and be used to address some of these challenges. But I want to sort of continue focusing on some of the sort of challenges that have been highlighted within collateral management. And Michael, maybe I can turn to you here to sort of talk about how the future might look and might be influenced by what's happened in COVID-19. And also sort of it's quite interesting the point that you were making about kind of, potential sort of shortage of collateral that has been highlighted by that, and maybe the need to sort of discuss eligibility of collateral a bit more. Michael, can I get your thoughts on this?
Yeah. Well, first, regarding some of the remarks regarding the development of collateral management going forward, I think at least from our perspective, collateral management was always more of a risk function than a regulatory function. We actually had the situations of 2008 where collateral management was already center stage. We in Europe had the European debt crisis, 2012. Then again, collateral management was in the center of the interest. And now we have COVID-19. I tend to feel that with collateral management, everybody is very focused on the collateral management function, and you even get calls from board members who have never been involved in the process and asking, I heard we had the difficulties with counterparty XYZ. Do we have the collateral now in place? And if not, should I give them a call? And it's like, well, normally the call to these guys is being given by collateral management team and not by a board member. And then everybody agrees that it's center stage, that it's very important, and as a crisis wears off, people start focusing on other parts of the infrastructure where they probably make more money. And my hope would be that, as many described this here in the call, as a wake-up call. I think it's a good wake-up call. It's again a good wake-up call for collateral management to become a center stage, to acknowledge its vital importance for risk management purposes, and also to ensure that the technology is there to support timely collateral calls, to get a very clear overview of about where your collaterals are, when they arrive, when you see first signs of staggered settlement, which is quite usual process in collateral management, because whenever you have a crisis, everybody is holding back. It starts with the money markets where everybody is holding back their transactions. Nobody wants to pay early. So then everybody waits and waits. So first develops a trickle, and then everybody sees that they are running into their cut-off times, and then you get a tsunami of cash and collateral moves, which has a tendency of overwhelming the respective back office department. So that is a certain pattern here. And I hope that the future will mean that there is enough attention from senior management to support the development of the collateral management function, and to make it more resilient and more robust, because actually it's, if you like, the first line of defense when it comes to issues like counterparty default. With regard to the regulatory side, I think we had a situation where all hands were needed on deck, and this meant nobody had time for strategic initiatives. Now, this actually, the situation has now changed. I think everybody is now switching back to the regulatory project, and this is why I tend to feel that well, in particular with the delays, everybody should be in time. Regarding the scarcity of the collaterals, I think we can shortly discuss it here, or probably also later. For instance, in Europe, we have the TLTROs coming up. I think people or market estimates are between 1.2 to 1.5 trillion in collaterals being absorbed. At the same time, we still have quantitative easing going on, which is another absorber of collateral. And in 2021, we will have unclear margin rules, which will be another absorber of collateral. Now, at the same time, obviously, we see huge fiscal programs, so we will also see a lot more supply. But I think we may have a situation that at least in the medium term there will be collateral shortages developing, because what we are seeing currently, at least in Europe, is people are already withdrawing collaterals from the market because they are building collateral pools that they intend to tender with the central bank. And once they have tendered the full lot, then obviously collateral will be scarcer, and I'm not so sure that government will issue in a timely fashion to support all the fiscal programs. So there may be some collateral squeezes in the medium term. So I think that is at least something that we are watching very carefully, and so we've built some collateral pools, and I argue also with our board that we need these kind of collateral pools just for the purpose to ensure that we do not need to tap collateral with, let's say, the second wave is coming in, because then I would feel we will have a changed situation that collaterals will become much more expensive, because they are now, then, for instance, all being tied up in quantitative easing or in TLTROs or whatsoever.
Okay, thanks. And Trevor, making collateral management more efficient and robust. I mean, how do you see the future playing out on this?
A lot of the points that have been made by the others. I mean, obviously, it's highlighted. I mean, as Michael said, first and foremost, collateral management is a risk function, and I think obviously the largest institutions have seen that. I think where there is potential weaknesses around how that's reported around the bank and around the firms. I think Michael said that people are ringing up, board members are ringing up and saying, can they make the calls? I mean, I think it's disseminating all of that information so that everybody that needs to know is aware of the situation, and that's obviously more important when people aren't in the office. You need to know the status of calls. Have they been made? Have they been agreed yet? Has the collateral been disputed? Because there's all sorts of methods that people use in order to delay whether they're going to pay a margin call. They'll potentially dispute, potentially don't pick up the phone. They're slow to agree the collateral that's being posted, and all of that needs to be communicated. And I think, as Kareem said, we need to know whether collateral has actually come in. So it's all very well making the margin call, agreeing the collateral, and thinking that it's all done, but obviously one needs to know whether the collateral has failed or whether it's actually been received yet. So it's getting that communication from your settlement systems back into your collateral system, and then onward forwarding that information to the credit risk departments, so that everybody's fully aware of the situation. Because obviously fails not only a risk issue, but also an inventory issue as well. So if you're not getting collateral in, then you're potentially not being able to fulfill your onward deliveries as well. So I think it's all about communication. I mean, before I was on the vendor side, I worked for running a collateral team, and it was all, back in the early crisis, it was always phone calls to inform people of where we were with the situation. Obviously, we want to get away from that so that people have the information at their fingertips on their laptops, so they can see exactly the status. Moving on to the scarcity of collateral that the speakers mentioned about. I mean, I think the other area that people need to focus on is, I suppose, two things really, in terms of the scarcity of collateral, which is not going to improve, I don't think, in the short term, is around reducing your margin requirements. So you need to reduce the amount of collateral that you are posting out, and you can do that by putting more trades through the clearinghouse, taking legacy trades and backloading those to the clearinghouses, because obviously there's lower IM requirements there. Potentially rebalancing between clearing houses and not a huge IM, and
so we seem to be having some communication difficulties, Trevor.
Hello, can you hear me?
Yes.
Can you hear me?
Yeah, I can hear you now. Sorry, we just missed the last part.
So compressing your positions so that you're reducing your notionals, and obviously reduced notionals, reduced IM, as well as pre-trade IM. So before you put a trade on, looking at where the best place to put it on from a lowest IM requirement perspective, and that's obviously then reducing your IM needs, and that's important from managing a collateral scarcity situation. And I suppose finally around the efficient management of your collateral inventory, and I'm sure some of the other guys will talk about this, but I think there's been a tendency for people to manage their businesses in quite a siloed basis. So you have OTC derivatives, you have repo, you have securities lending, you have your cleared, your prime brokerage, but actually you're all users of collateral, and managing that collateral at a sort of global level will obviously make things much, much more efficient, and having that visibility and accessibility to that global pool, and also ensuring that the people that are incurring the costs pay for it. So it's not a sort of grouped cost that gets divvied up, but actually gets allocated back to those business units that are incurring those costs. And around obviously collateral optimization, so you may want something very clever, like a linear programming optimization tool, but even simple laddering, where you can actually preference your collateral better, particularly in this crisis where you have potentially a real shortage in the short term. So there's no point in posting out US Treasuries on an agreement which accepts US Treasuries and Euro government bonds. Then when you go to post some collateral out on an agreement that only accepts US Treasuries, then you don't have any. So it's managing that in a much more efficient and global way, ensuring that you're using the preferred collateral on the correct agreements.
Okay, thank you. And let's follow up on the issue of the collateral squeeze. And I'll turn to Teruhiko here from a sort of Japanese perspective, perhaps. I mean, should eligible collateral be widened? Is that a debate that's going to start?
Okay, let me give some insights of my own personal thoughts. Well, during this time of crisis, actually the liquidity was very impacted as market players scrambled to get their hands on the collaterals as much as possible. Now everybody is aware that the reliable collateral means is cash. Cash in hand is good, which means that 100 yen is always 100 yen. It does not depreciate, it does not appreciate. So settlement regarding the T1 settlement ends, it's more easier to meet your requirements if you're using cash. So this is actually, in Mizuho actually, we try to use cash as much as possible regarding the VMs. And we are negotiating with customers if they're using like JGBs and, other sorts of financial instruments. We try to use cash as much as possible because that's more easier to handle. The settlement and meeting the T1 settlement requirements, cash is more easier. One thing which I'm worried actually is the world economy is going down and everybody knows that's happening. Now this may lead to a very high downturn on their revenues. So banks and like local banks, corporates, they may face a bankruptcy. And if this happens to many other countries, it's not just Japan. This could be leading to a downgrading of a country ratings by Standard & Poor's, Moody's, and whatever's. Now, if this triggers a downgrading of a country rating, this trigger actually will kick some kind of a trigger of a certain eligibility criteria in the eligible collateral schedules. This is set forth by the global custodians, and I think many of you you may be aware. So if this happens, such as like concentration limits, we may have to post a different set of collaterals instead of cash. And that means that we need a new set of eligible collaterals. And I know many banks actually, regarding if this is IMs, we have not, only like JGBs, the Japanese, government bonds. We could have like U.S. Treasuries, European bonds, gilts. But in order for a bank to be ready to expand your eligible collaterals, this is something which in the future you must definitely consider. But in the short time, what actually happened is that many people, they have many different types of eligible collaterals in their collateral schedules. Did you use many of them? I think no, they didn't use much. Actually, if you were European banks, you used euros. If you're American bank, I think you used US dollar cash. And most certainly, Japanese banks, we were using cash because that was very easy to handle and to get. But we try not to expand as much, too much, as now if you are a Japanese bank and you are taking in like foreign currencies as a different collateral methods, now you are taking in another different risks, which could be like, the basis risk from currency mismatch. You have your liquidity risk, and you'll have other risks. Actually, the collateral exchange is we have to like decrease the counterparty risks. So now that is like risk mitigations. But you have to be very careful on how and what to expand. And if you're definitely using a foreign currencies, you need to look in a different aspect of risks, which is not just like counterparty risk. You'll have liquidity problems, you'll have like basis risk, and you'll have other bunch of risks, which will, you have to deal with. So I am kind of like a conservative, but what I am trying to say is like it is best in the short term to try to stick to your own mother currencies as you will feel more comfortable. But this does not always mean that you are safe in the middle term and the long term. So in this case, we need to like balance out what we have in hand, and what Trevor and Michael also mentioned is that this visibility of your pool collaterals, your accessibilities, and like global management, these aspects is what we have to look into. And regarding the visibility, I just cannot like sit here and take a look at all of my collateral pools. We need like system enhancements so that we can have access to this in real time. Okay, so these kind of aspects is that we would like to take a look.
Okay. Thanks for all of your thoughts on that. Really useful. So I wanted to sort of, for the next 10 minutes, spend a bit of time sort of talk about technology and the extent to which technology can help in some of the collateral management challenges that organizations are facing. So to kick off that discussion, we'll turn to our third polling question, which is asking the audience what the 3 priorities in collateral management technology are over the coming year. And the choices are AI machine learning, public APIs and connectivity, microservices, deploying on the clouds, regulatory functionality, and vendor consolidation. So I'll just wait for 15 seconds for the results to come in. Okay, we'll take a look at the results and see that regulatory functionality is the significant one there. So maybe I'll get Trevor to give some thoughts first on the sort of technology side of things. So we've heard some of the sort of challenges, some of the issues, particularly highlighted by the COVID-19 pandemic this year. So to what extent can technology help overcome some of these challenges, and what are the limitations? Trevor?
Yeah, I mean, I think, the poll showed regulatory functionality, and obviously that's very important, and I think all vendors, including ourselves, will ensure that your regulatory support is there. But I think the point I wanted to make, I think the poll's changed now. There was a few more responses there, as I saw on the screen. But I wanted to sort of talk really about a number of things really, but certainly around the connectivity. So we've talked about some interesting points around inventory management, around eligibility, around credit risk management, that kind of thing. And I think the point to understand is that the collateral management system sits at the center of your banking ecosystem, as it were, and it needs to receive information in, and it needs to send information out to downstream and upstream systems. For example, we've got to send information on the status of calls to credit risk management. There's the inventory management, receiving the positions in that you're taking, as well as the global inventory consumed in, as well as from a settlements perspective, you've got the you need to be able to send information down to your settlement systems in terms of the collateral bookings, as well as their statuses of whether they failed or settled back in. Also around documentation, so CSA and legal agreement updates need to come in. Again, we've seen because people are working from home, this push digitized agreements has had a real kicker. So there's a real importance for the system to be able to sort of sit with a web of connections off to all the different providers of information and consumers of information. And that's not only internally as well, because obviously there's the external providers like Acadia Soft and your tri-party custodians and your SIM providers and so on. So it's very, very important that you have a connected system. And I think, what we see as very important is having a comprehensive API strategy to achieve that. So you need that, those connections intended, that are public, intended for use by clients, so not private, just for internal usage, to give firms that sort of programmatic connectivity. And the APIs need to be fully documented. They need to be well versioned, stable over the very long term, and also compatible backwardly, backwardly compatible, because you need, when the API is enhanced to accept new data, it needs to also to be able to receive data in the previous format. And when it receives new data in, it needs to accept and interpret that from previous kinds. So I suppose the point is that if the big issue that firms often have in terms of upgrading their systems is that they have to rebuild or recompile all of the connectivities, and that can be a massive web of connectivities around the firm. If you can do that so that the APIs remain static and there's no recompiling needing to go on because they still work with the old formats and are fully backwardly compatible, then you can upgrade in confidence that your APIs are there and working as they've always been. So it future-proofs your application. So I really think that a good, solid global API strategy is very important, and I think this COVID crisis has only demonstrated that with everybody working from home. You've not had that human communication in the same way as you've had in the past, so you definitely need that electronic or digitized communication. And I suppose the connectivity aspect of it plays into the overall strategy for automation. So you have, I see there's a number of pillars for automation, connectivity being one through your API strategy, as well as standardizing your data as much as possible. And we've seen that with initiatives like the CDM and also the SIM and taxonomy on eligible buckets. And the other sort of strand is around outsourcing your IT, so hosting or cloud deployment, which has been mentioned by Kuni-san as well. That's very important as a potential strategy, particularly in this remote working environment. And with that outsourcing of IT, you've obviously got lower upfront costs. You haven't got any hardware maintenance. The upgrades are much more straightforward. You've got disaster recovery built in, shared operational costs, all of those benefits with outsourcing your IT. Once you get those sort of three pillars of connectivity, standardization, and outsourcing, you can then look at more interesting stuff like AI and machine learning, looking at ways to make decisions around sending your calls out, responding to your calls, and so on, reconciling your portfolios. So I see, big important thing is the connectivity, and that plays into the overall automation strategy that firms should be looking at.
Okay, thanks for that, Trevor. So we don't have long. We've only got a few minutes left. We don't have long, but I'd like to get the views from from the banks on the panel about the sort of evolving role of technology within the collateral management space. So Kareem, maybe I can go to you here first. Just some very quick final thoughts on the sort of technology aspect.
Yeah, I think from what Trevor described, and also if we link it back to a number of the concepts that were mentioned earlier, I think standardization is definitely something that is slowly making its way in the collateral world. I mean, and let's not forget that we're probably coming from an environment which was, purely bespoke and pretty much bilateral, and gradually over the last few years, you started having more standardization, which then has helped technology providers to come up with solutions that are addressing or supporting a life cycle, and the design of something, in my view, that is extremely important, the capability to manage a exception-driven process, because you don't want your operational team just to run on doing all the same repetitive tasks. You want them to assess and take action on the exceptions, where in fact the added value of a real person putting things in perspective and taking a decision is effectively going to be critical. The other thing I would say is that has not been necessarily mentioned so far is about quality of the data that feeds into the system, because it's definitely determining what quality of collateral you're going to end up with, and I think that's probably something that I'm sure is part of the agenda of the technology providers, but I just like to put the focus on it, because you can only be as strong as your weakest link, and if you haven't got like the proper information about the price or rating or something else on the collateral that you have in, then it's not going to be worth what you expect from it.
Okay, thanks, Kareem. And last word to Michael on the technology side of things, literally in 2 minutes. What do you think are the sort of key technologies that will be useful in this going forwards?
Okay, 2 minutes is difficult, but I try. So I think at the beginning we started to look into artificial intelligence to increase the efficiency of our collateral management unit, and we failed to some extent, because why? You need reliable data, you need lots of data points, and actually it has to be real data. And we found out that the issue very often in collateral management is that when you have a settlement fail, well, you book a transaction, but the security does not arrive, right? And you do not know when it arrives. Yeah, and the same actually goes for cash settlement purposes. So what you actually need is a system which gives you real-time data on the state of affairs. And that is normally something where we found that AI probably is not the right product for. So we actually came up with a blockchain-based a settlement account system for security settlement, and we're currently running a couple of test transactions with a couple of partners, and look into probably rolling this out as a protocol for international security settlement as a test within the next couple of months, and we are currently talking to a couple of banks to see whether they would be interested.
Okay, thanks, Michael. Very succinctly done. I'm sure there's much more we could talk about technology and collateral management, but unfortunately the time escapes us. So all that remains for me to do is to thank our panelists, Trevor Negus from SmartStream, Karim Chaban from Citi, Michael Sears from DekaBank, and Teruhiko Kuniyasu from Mizuho Bank, and to all of you for tuning in. Until next time, goodbye.